This video is for educational purposes only and does not constitute investment advice. I lost everything in 17 minutes. Not metaphorically, not exaggerating for dramatic effect. I'm talking about 17 actual minutes where I watched my entire trading account get obliterated while I sat frozen in my apartment at 3 in the morning, the blue glow of my monitors reflecting off my sweaty face as I clicked buy and sell buttons like some deranged video game player who forgot he was playing with real money. But here's the thing that really haunts me about that night, and why I'm telling you this story right now, because what happened in those 17 minutes wasn't the real disaster. The real disaster was the 3 years of obsessive, manic, sleep-deprived trading that led up to that moment. And if you're watching this video, there's a good chance you're somewhere on that same path right now. See, I used to be one of those traders. You know the type. The ones refreshing their portfolio every 30 seconds, jumping into trades based on a random tweet they saw, chasing every pump, every breakout, every hot stock tip from some guy on Reddit who claimed he turned $500 into $50,000 in 2 weeks. I was addicted to the action, addicted to the possibility that the next trade, the very next one, would be the one that changed everything. And I want you to remember that feeling as I tell you this story, because by the end of this video, you're going to understand why that feeling, that exact addiction, is the one thing standing between you and actual trading success. But before I tell you how I lost everything and then built it all back, let me ask you something. How many trades did you make last week? Actually think about it. Don't just give me some vague number. Count them. I'll wait. Because if it's more than 5, if it's more than 10, if you're making trades every single day, then what I'm about to share with you could literally save your trading account. And I don't say that lightly. My name is Marcus, and 3 years ago I was working as a software engineer in San Francisco, making decent money, living in a tiny apartment that cost more than most people's mortgage payments, and completely miserable. Not because of the job, not because of the city, but because every spare moment I had was consumed by trading. I'd wake up at 5 a.m. to catch the pre-market action. I'd sneak trades during my lunch break. I'd stay up until midnight analyzing charts and reading trading forums. My girlfriend Sarah used to joke that I loved my trading app more than I loved her. She stopped joking about it right around the time I spent our vacation fund on what I was absolutely certain was going to be the trade of a lifetime. Here's what I want you to understand about that version of me. I wasn't some gambling addict. I wasn't some reckless kid throwing money at meme stocks. I was actually pretty good at analysis. I could read charts. I understood technical indicators. I had a system. The problem wasn't that I didn't know what I was doing. The problem was that I was doing it constantly, every single day, multiple times a day. I was treating the stock market like a slot machine instead of what it actually is, which is a wealth transfer mechanism from impatient people to patient people. And the crazy part? Some of my trades were actually profitable. In fact, a lot of them were. I had this spreadsheet where I tracked everything, and my win rate was around 65%. I remember feeling so proud of that number. 65%. I was beating the market. I was a trading genius. What I didn't realize, what I couldn't see because I was so caught up in the action, was that my few big losses were completely wiping out my many small wins. It's like being a poker player who wins a bunch of small hands but then loses his entire bankroll on one bad bluff. The math doesn't care about your win rate if your risk management is garbage. But I'm getting ahead of myself. Let me tell you about Jake Morrison. You probably don't know that name, but you should, because Jake Morrison taught me the most expensive lesson of my trading career. Jake Morrison was this guy I found on Twitter who claimed he'd turned $20,000 into $2 million in 18 months. He posted screenshots. He shared his trades. He had this whole following of people hanging on his every word. And one Tuesday morning in March, Jake Morrison posted about this biotech stock that was about to announce trial results. He said he was going all in. He said it was a once-in-a-lifetime opportunity. He said if you weren't buying, you were missing out on generational wealth. So naturally, I bought. Not just a little bit. I'm talking about 40% of my entire trading account. 40%. On one stock. Based on a tweet. From a guy I'd never met. And for about 6 hours, I felt like a genius. The stock was up 12%. I was calculating how much money I'd made, thinking about what I was going to do with the profits, already planning my next move. That's when the FDA released their statement. The trial results weren't just bad. They were catastrophic. The drug didn't work. There were safety concerns. Trading was halted. When it reopened the next morning, the stock was down 78%. 78%. In one day. And Jake Morrison? Jake Morrison deleted his Twitter account. Just vanished. Like he'd never existed. Like the $200,000 I'd just lost was just some number on a screen that didn't matter. But here's the thing that really broke me. It wasn't just the money. Money you can make back. It was the realization that I'd become exactly the kind of trader I used to make fun of. The kind who chases tips and rumors and hot stocks instead of having any kind of actual strategy. I'd turned into a day trader stereotype, and I didn't even realize it was happening. That night, sitting in my apartment, staring at my portfolio showing a loss that represented 2 years of savings, I made a decision that changed everything. I was going to quit trading. Not temporarily. Not for a few weeks to clear my head. I was going to close my accounts, delete my apps, and never look at a stock chart again. And I probably would have, except for something my dad said to me during a phone call the next morning. My dad has never traded a stock in his life. He's a mechanic in Ohio who thinks the stock market is basically legalized gambling. But when I told him what happened, when I was going through my whole sob story about losing money and how the market was rigged and how it was impossible to make money trading, he said something that stopped me cold. He said, "Marcus, you know what the difference is between a good mechanic and a bad mechanic? A good mechanic only uses his tools when he needs them. A bad mechanic thinks every problem is a nail because he's in love with his hammer." That hit me like a truck, because that's exactly what I'd been doing. I'd fallen in love with the hammer. I'd fallen in love with the act of trading itself, not with the results it was supposed to produce. I was making trades because I enjoyed making trades, not because the trades made sense. I was chasing the feeling of being in the market instead of chasing profits. So instead of quitting, I decided to do something different. Something that probably saved my trading career and definitely changed my entire approach to investing. I decided to only make one trade per month. One. That's it. No exceptions, no special circumstances, no just this once trades. One trade, 30 days. That was the rule. And let me tell you, the first month was torture. Pure torture. Do you know how hard it is to watch the market move every single day and not be able to do anything about it? Do you know what it's like to see a stock you've been watching gap up 15% and not be allowed to buy it because you already made your one trade for the month? It was like being on a diet and having to walk past a bakery every single day. But something interesting started happening. When you can only make one trade per month, you become very, very careful about which trade you choose. You can't just impulse buy something because it's moving. You can't chase momentum. You have to actually think. You have to research. You have to wait for the absolute best setup, because you only get one shot. My first month under this new rule, I spent 3 weeks analyzing different opportunities. I looked at earnings reports, I studied technical patterns, I read analyst reports, I even called the investor relations department of companies I was considering. And when I finally pulled the trigger on day 28, it was the most confident I'd ever felt about a trade in my life. The stock was Nvidia. This was back in early 2020 before anyone was talking about AI, and I bought it at $237 because I believed the gaming market was about to explode, and they were the best positioned company to benefit. That one trade made me more money in 30 days than I'd made in the previous 6 months of constant trading. More importantly, it taught me something that completely changed how I think about the markets. The opportunity cost of making bad trades isn't just the money you lose on those trades. It's all the good trades you miss because your capital is tied up in garbage. Think about it this way. Let's say you have $10,000 to trade with. If you spread that across 20 different positions, you've got $500 working in each trade. But if you concentrate that into 2 or 3 really high conviction positions, now you've got $3,000 or $5,000 working in each trade. When one of those trades works out, which one do you think makes you more money? The $500 position that goes up 20%? Or the $3,000 position that goes up 20%? This is what I call the concentration principle. And it's the opposite of everything you've been taught about diversification. Diversification is for people who don't know what they're doing. Concentration is for people who've done their homework. Warren Buffett doesn't own 300 stocks. He owns maybe 20 companies that he understands incredibly well. Peter Lynch didn't make his fortune by buying every stock that looked interesting. He made it by finding a few exceptional companies and betting big when he found them. But here's where most traders get this wrong. They think concentration means taking bigger risks. It doesn't. It means taking fewer, better risks. It means spending more time on research and less time on execution. It means being patient enough to wait for the really obvious opportunities instead of trying to create opportunities where none exist. Let me give you a perfect example of what I mean. In May of 2020, I was looking at Zoom. This was right in the middle of the pandemic lockdowns. Everyone was working from home. The stock had already run up significantly, and most traders were starting to look for the next hot thing. But I spent 2 weeks really digging into their business model. I looked at their customer retention rates, their expansion into enterprise accounts, their competitive moats, their management team. And what I found was a company that wasn't just benefiting from a temporary pandemic boost. They were building a platform that was going to fundamentally change how people work. So instead of looking for something new and exciting, I used my one trade that month to buy more Zoom at what everyone else thought was too high of a price, $412 per share. People thought I was crazy. The pandemic trade is over, they said. Everyone's going back to the office, they said. You're buying at the top, they said. That trade made me more money than every trade I'd made in the previous year combined. Not because I was smarter than everyone else, but because I was more patient. I was willing to do the work that other traders weren't willing to do. I was willing to hold a position while other people were chasing the next shiny object. And that's when I realized something that changed everything. The traders who make consistent money aren't the ones who trade the most. They're the ones who trade the best. They're not trying to catch every move in the market. They're waiting for the moves that they can't possibly miss. But let's be honest about something. What I'm describing isn't easy. It goes against every instinct you have as a trader. Your brain is wired to want action. It's wired to want to feel like you're doing something productive. Sitting on the sidelines while the market moves feels like you're missing out. There's actually a name for this psychological bias. It's called action bias, and it's the reason most traders fail. Action bias is why soccer goalkeepers dive to one side or the other on penalty kicks, even though staying in the center gives them the best chance of making a save. It's why doctors overprescribe antibiotics even when they know the patient's condition will resolve on its own. And it's why traders make trades even when there's no good reason to trade. We feel like we need to be doing something, even when doing nothing would be better. Fighting action bias is like fighting gravity. It takes constant effort and discipline. But here's what I learned during my second month of the one trade rule. The longer you can resist the urge to trade, the better your eventual trade becomes. It's like the market rewards patience. The traders who can wait weeks or months for the perfect setup are the ones who get the perfect setup. My second month, I waited until the very last day to make my trade. Day 31, I bought Tesla at $394. Not because I loved the company. Not because I believed in Elon Musk's vision for the future. But because I'd been watching the technical setup for weeks, and it had finally reached a point where the risk-reward ratio was irresistible. The stock had been consolidating in a tight range, volume was drying up, and every technical indicator I followed was pointing to an imminent breakout. 3 weeks later, Tesla announced their inclusion in the S&P 500, and the stock doubled in 3 weeks. And I captured most of that move because I wasn't distracted by 20 other positions. I wasn't second-guessing myself because I'd done the research. I wasn't taking profits early because I knew exactly why I'd bought the stock and what it would take for me to sell it. That's when I started to understand what professional traders mean when they talk about having an edge. Your edge isn't some secret strategy or insider information. Your edge is discipline. Your edge is patience. Your edge is being able to sit on your hands when everyone else is panic buying or panic selling. Your edge is doing less, not more. But I want to be completely honest with you about something. Even after these early successes, I still struggled with the urge to trade more frequently. There were days when I'd watch a stock gap up 10% and feel physically sick that I couldn't buy it because I'd already made my trade for the month. There were weeks when I'd second-guess my entire approach and wonder if I was being too conservative, too cautious, too slow. The turning point came during my 4th month of this experiment. It was August 2020, and there was this massive rally happening in tech stocks. I mean, everything was going up. Apple, Amazon, Netflix, Facebook, they were all hitting new highs every single day. And I was sitting there with my one position, watching my account grow steadily but slowly, while people on Twitter were posting screenshots of 50% gains in single trading sessions. I started to crack. I started to rationalize why I should break my rule. This is different, I told myself. This is a once-in-a-generation opportunity. I'll just make one extra trade this month and then go back to the rule. The rule was arbitrary anyway. Does this sound familiar? Because if you've ever tried to stick to any kind of trading discipline, you've probably had this exact conversation with yourself. And I almost did it. I almost broke my rule and bought into the rally. I had my finger on the buy button for Shopify at $800 per share, convinced that I was about to miss out on massive profits. But something stopped me. It wasn't discipline. It wasn't willpower. It was fear. Fear that if I broke my rule once, I'd break it again. Fear that I'd go back to being the trader I used to be, the one who chased every opportunity and caught none of them. So I didn't buy Shopify. I stuck to my rule. I watched the stock continue to rally for another 2 weeks. And then, I watched it crash back down to $600 when the tech bubble burst in September. The traders who'd been posting screenshots of their massive gains suddenly went quiet. The forums filled up with loss porn and sob stories. And I realized that my rule hadn't just saved me from missing out on profits. It had saved me from participating in a bubble that I couldn't see while I was in it. That's when everything clicked. The purpose of limiting my trades wasn't to make me more conservative, it was to make me more selective. It was to force me to distinguish between good opportunities and great opportunities. Because here's the thing about markets. Good opportunities happen every day. Great opportunities happen maybe 3 or 4 times per year. And if you're constantly chasing good opportunities, you'll never have the capital available when the great opportunities show up. Let me give you a concrete example of what I mean. In March 2020, when the pandemic first hit and the market crashed, there were incredible buying opportunities everywhere. I'm talking about high-quality companies trading at ridiculous discounts. Apple was down 30%. Microsoft was down 35%. Amazon was down 25%. These were companies that weren't going anywhere, that were actually going to benefit from the pandemic, but they were being sold indiscriminately along with everything else. Now, if you were a trader who was constantly in and out of positions, constantly chasing the next hot stock, you probably didn't have any cash available during that crash. You were probably already fully invested in positions that were also getting crushed. But if you were patient, if you were selective, if you were sitting on cash waiting for exactly this kind of opportunity, you could have bought world-class businesses at decade-low prices. I used my March trade to buy Microsoft at $137. Not because I thought it would bounce back quickly, but because I believed it was the best technology company in the world, trading at a discount that might not happen again in my lifetime. I didn't care if it took 6 months or 2 years to recover. I knew that eventually, the market would recognize what I was seeing, and I'd be rewarded for my patience. That trade is still working for me today. Microsoft hit $400 per share last year. That's almost a 300% return on one trade. One trade that I held for over 2 years. One trade that required no maintenance, no stress, no sleepless nights watching charts. I bought it, I held it, and I let the business do what great businesses do, which is compound wealth over time. But here's what I really want you to understand about this approach. It's not just about making money. It's about reclaiming your life. When you're constantly trading, constantly monitoring positions, constantly looking for the next opportunity, you're not really living. You're existing in this state of perpetual anxiety where every market move affects your mood, every news headline affects your decisions, every day feels like a battle that you might lose. When I switched to making one trade per month, I got my life back. I started sleeping better. My relationship with Sarah improved dramatically. I became better at my day job because I wasn't distracted by trading all the time. I rediscovered hobbies that I'd abandoned. I started reading books again. Not just trading books, but novels and biographies and things that had nothing to do with making money. And paradoxically, the less I focused on trading, the better I became at it. When you're not emotionally attached to every market move, you can think more clearly. When you're not under pressure to make money every single day, you can wait for the really obvious opportunities. When you're not constantly second-guessing yourself, you can stick to your plan and let your winners run. This is what I call the paradox of profitable trading. The traders who need the money the least are the ones who make the most money. The traders who can afford to wait are the ones who get the best prices. The traders who aren't desperate for action are the ones who find the best opportunities. But I know what some of you are thinking. This sounds great in theory, but what about day trading? What about scalping? What about all those traders who make money on quick moves and high-frequency trading? And you're right to ask about this, because there are traders who make money with high-frequency strategies. But here's what they won't tell you. For every trader who makes money day trading, there are 99 traders who lose money day trading. The success rate is that low. And even for the traders who are successful at day trading, it's not a sustainable lifestyle. It's incredibly stressful, incredibly time-consuming, and incredibly risky. You're competing against algorithms that can process information faster than you can think. You're competing against professional trading firms with better technology, better information, and more capital than you'll ever have. You're trying to predict short-term price movements in markets that are essentially random over short time periods. Compare that to what I'm describing. I'm not trying to predict what a stock will do tomorrow or next week. I'm trying to identify businesses that will be worth more in 5 years than they are today. I'm not competing against high-frequency trading algorithms. I'm investing alongside the smartest money managers in the world. I'm not stressed about every tick of the market. I'm confident that time and compound growth are working in my favor. Let me tell you about my biggest winner under this system. In November 2020, I used my monthly trade to buy a company called CrowdStrike at $153 per share. Most people had never heard of CrowdStrike. They're a cybersecurity company that protects businesses from hackers and malware. Not exactly sexy. Not the kind of stock that gets people excited on social media. But I'd been following the cybersecurity space for months, and everything I read convinced me that cyber attacks were going to become a massive problem for businesses. The pandemic had forced companies to move operations online quickly, often without proper security measures. Nation-state hackers were becoming more sophisticated. Ransomware attacks were increasing exponentially, and CrowdStrike had the best technology and the strongest competitive position in this growing market. The stock didn't move much for the first few months. It bounced around between $150 and $180. Other traders would have gotten impatient and sold. They would have moved on to something with more action, more volatility, more immediate gratification. But I held. I held because I believed in the thesis, and because my research told me that the cybersecurity market was going to explode, and CrowdStrike was going to be one of the biggest beneficiaries. 18 months later, CrowdStrike hit $300 per share. That's a 100% return on a stock that most traders ignored because it wasn't flashy enough, wasn't moving fast enough, wasn't giving them the immediate dopamine hit they were looking for. But sometimes the best trades are the boring trades. Sometimes the biggest profits come from the companies that quietly execute their business plan while everyone else is chasing the latest meme stock. That CrowdStrike trade taught me something crucial about market psychology. The stocks that get the most attention, the ones that everyone is talking about, the ones that are moving the fastest, those are rarely the best investments. They're entertainment, they're gambling, they're designed to separate impatient traders from their money. The best investments are often hiding in plain sight. They're the companies with boring business models and predictable growth rates. They're the stocks that institutional investors are quietly accumulating, while retail traders are chasing whatever Elon Musk tweeted about that day. They're the opportunities that require actual research and analysis to identify, not just the ability to react quickly to price movements. This realization completely changed how I evaluate trading opportunities. I stopped looking for stocks that were about to move. I started looking for businesses that were about to grow. I stopped trying to time the market. I started trying to time the business cycle. I stopped caring about technical analysis and started caring about fundamental analysis. Don't get me wrong, technical analysis has its place. Chart patterns and price movements can tell you a lot about market sentiment and help you time your entries and exits. But if you're relying solely on technical analysis, if you're buying stocks just because they broke out of a resistance level or crossed above a moving average, you're basically gambling. You're hoping that other traders will react to the same signals you're seeing and push the price higher. There's no underlying logic to support your investment thesis. Fundamental analysis is different. When you buy a stock based on fundamental analysis, you're buying it because you believe the underlying business is going to become more valuable over time. You're not depending on other traders to validate your decision. You're depending on the company's management to execute their business plan and generate increasing profits year after year. Let me give you an example of how this plays out in practice. In February 2021, there was this massive rally in electric vehicle stocks. I'm talking about companies like Lordstown Motors, Fisker, Lucid Motors, companies that didn't even have products on the market yet but were trading at multi-billion-dollar valuations based on nothing but promises and presentations. At the same time, Tesla, which actually had a working product and growing sales and increasing market share, was trading at what seemed like a reasonable valuation compared to these speculative plays. But Tesla wasn't sexy anymore. It wasn't the new thing. It had already had its big run, and traders were looking for the next Tesla, not Tesla itself. I used my February trade to buy more Tesla at $750 per share. Not because I thought it would have another explosive rally, but because I believed the electric vehicle market was still in its infancy, and Tesla had the best technology, the best manufacturing capabilities, and the strongest brand in the space. I bought it as a long-term hold, expecting to own it for years, not months. Most of those other electric vehicle stocks crashed back down to earth within 6 months. Lordstown is basically worthless now. Fisker filed for bankruptcy. Lucid Motors lost 90% of its value. Meanwhile, Tesla continued to grow its business, continued to increase sales, continued to expand internationally. The stock has been volatile, but the underlying business has gotten stronger every quarter. That's the difference between investing and speculating. When you invest, you're buying a piece of a business that you believe will be worth more in the future. When you speculate, you're buying a ticker symbol that you hope other people will bid up. One of these strategies has a logical foundation. The other is just momentum trading with extra steps. But here's where this gets really interesting. As I got better at identifying quality businesses trading at reasonable prices, as I got more patient about waiting for the right opportunities, as I became more disciplined about sticking to my one trade per month rule, something unexpected happened. I started making so much money that I had to change the rule. By the middle of 2021, my trading account had grown to the point where one trade per month was representing massive dollar amounts. I was putting $50,000, $75,000, sometimes over $100,000 into single positions. And while I was confident in my analysis, concentrating that much money in individual stocks was starting to feel irresponsible. So I modified the rule. Instead of one trade per month, I allowed myself up to 3 trades per month, but with a twist. Each trade had to represent a different investment thesis. I couldn't just buy 3 different technology stocks or 3 different growth stocks. I had to diversify across sectors, across investment styles, across time horizons. This forced me to become even more analytical about my decisions. I had to understand not just individual companies, but entire industries. I had to think about economic cycles, interest rate trends, geopolitical factors. I had to develop a macroeconomic framework for understanding how different types of investments would perform under different market conditions. One month, I might buy a growth stock like Shopify, a value stock like Berkshire Hathaway, and a dividend stock like Johnson & Johnson. Another month, I might buy a small-cap biotech company, a large-cap technology company, and a real estate investment trust. The key was that each position had to make sense on its own merits, and together they had to create a portfolio that could perform well, regardless of what the market threw at it. This approach served me incredibly well during the market volatility of 2022 and 2023. While traders who were concentrated in growth stocks got crushed when interest rates started rising, while traders who were chasing meme stocks lost everything when the speculation bubble burst, my diversified approach allowed me to weather the storm and even profit from the chaos. I remember one particular month in October 2022, when the market was in free fall. Everyone was panicking, selling everything, convinced that we were headed for another 2008-style financial crisis. I used that month's 3 trades to buy Coca-Cola at $58, Apple at $142, and a small position in Bitcoin at $18,000. People thought I was crazy. The market is crashing and you're buying, they said. Wait for it to go lower, they said. This is just the beginning of the bear market, they said. But I'd learned something important about market cycles. The best time to buy is when everyone else is selling. The best opportunities appear when sentiment is at its worst. The biggest profits go to the traders who can think independently and act contrarian when the situation calls for it. All 3 of those trades worked out beautifully. Coca-Cola proved to be a safe haven during the volatility and has continued to pay reliable dividends. Apple demonstrated once again why it's one of the most resilient companies in the world. And Bitcoin, well, Bitcoin did what Bitcoin does, which is reward patient investors who can stomach the volatility. But the most important thing I learned during this period wasn't about individual trades or market timing. It was about the psychology of successful trading. The traders who make money consistently aren't the ones who are always right. They're the ones who can be wrong without letting it destroy them financially or emotionally. When you're making dozens of trades per month, every loss feels personal. Every mistake feels like evidence that you don't know what you're doing. Every wrong decision reinforces the belief that trading is just sophisticated gambling. But when you're making 3 carefully researched trades per month, when you've done your homework and you understand exactly why you're buying what you're buying, losses don't feel like failures. They feel like learning experiences. Let me tell you about one of my biggest learning experiences. In June 2022, I bought a stock called Peloton at $12 per share. This was after the stock had crashed from its pandemic highs of over $160. The company was struggling with supply chain issues, demand was declining as people returned to gyms, and there were questions about the long-term viability of their business model. But I thought the market had overreacted. I believed that connected fitness was here to stay, that Peloton had built a strong brand and a loyal customer base, and that at $12 per share, the stock was pricing in a bankruptcy scenario that seemed unlikely, given their cash position and ongoing revenue streams. I was wrong. Dead wrong. Dead. The stock continued to decline, hitting a low of around $8 before eventually being acquired by another company, at a price that represented a significant loss for me. It was one of my worst trades under the new system, and it taught me some valuable lessons about catching falling knives and trying to time bottoms in beaten-down stocks. But here's the key difference between this loss and the losses I used to experience when I was overtrading. Because I'd only allocated a small portion of my portfolio to Peloton, because I hadn't leveraged the position or put more money than I could afford to lose, the loss didn't devastate me financially. And because I'd done thorough research before buying, because I understood exactly why I thought the stock was undervalued, I could analyze what went wrong without feeling like I'd made a completely irrational decision. I learned that sometimes the market is right, even when it seems irrational. I learned that turnaround stories are harder to predict than growth stories. I learned that consumer discretionary companies are more vulnerable to economic downturns than I'd previously realized. These weren't just abstract lessons. They were specific, actionable insights that made me a better investor going forward. That's the beauty of a disciplined, research-driven approach to trading. Even your losses teach you something valuable. Even your mistakes make you smarter. Every trade becomes a case study that improves your decision-making process for future trades. Compare that to what happens when you're overtrading. When you're making impulsive decisions based on emotions or momentum or hot tips, your losses don't teach you anything except that trading is hard and the market is unpredictable. You can't learn from mistakes when you don't understand why you made them in the first place. This is why I'm so passionate about sharing this approach with other traders. Not because I think everyone should follow exactly the same system I use, but because I think everyone should understand the principles behind successful trading. Patience over action, quality over quantity, research over intuition, discipline over emotion. These aren't just trading concepts. They're life concepts that apply to any situation where you're trying to make good decisions under uncertainty. And trading is absolutely a situation where you're making decisions under uncertainty. No one knows what the market is going to do tomorrow or next week or next month. No one can predict with certainty which stocks will go up and which will go down. But what you can do is stack the odds in your favor by choosing high-quality investments and being patient enough to let them work. Think about it like this. If you had to bet on the outcome of a coin flip, you'd have a 50% chance of winning. But if you could choose to bet on a weighted coin that came up heads 60% of the time, you'd take that bet every time, right? That's essentially what good investing is. You're not trying to predict the unpredictable. You're trying to find situations where the odds are tilted in your favor, and then you're betting accordingly. The stocks I buy aren't guaranteed to go up, but they're companies with strong competitive advantages, growing markets, competent management teams, and reasonable valuations. Over time, more of these investments will work out than won't. And the ones that work out will more than compensate for the ones that don't. But you can only take advantage of this edge if you're disciplined enough to stick to the process, patient enough to let it work, and smart enough to learn from both your successes and your failures. You can't let emotions drive your decisions. You can't chase performance. You can't abandon your strategy just because it's not working in the short term. This is where most traders fail. Not because they can't identify good investments, but because they can't stick to their plan when things get difficult. They buy high-quality stocks and then sell them at the first sign of trouble. They develop a system that works and then abandon it the first time it produces a loss. They have good ideas, but terrible execution. I want to tell you about the most important trade I never made. It was March 2023, and there was this massive banking crisis happening. Silicon Valley Bank had collapsed. Credit Suisse was in trouble. There were fears about contagion spreading throughout the financial system. Bank stocks were getting absolutely destroyed. And I mean destroyed. Some of them were down 50, some of 60, even 70% in a matter of days. I spent weeks researching regional banks, trying to identify which ones were fundamentally sound and just being caught up in the panic selling. I found several that looked incredibly attractive at their depressed prices. Strong loan portfolios, conservative management, solid capital ratios, trading at book value or below. These were exactly the kind of contrarian opportunities that had worked so well for me in the past. But I didn't buy any of them. Not because I didn't believe in the analysis. I was actually very confident that several of these banks were massively undervalued. I didn't buy them because I realized I didn't understand the banking industry well enough to distinguish between temporary problems and existential threats. I didn't have the expertise to evaluate credit risk, or interest rate risk, or regulatory risk at the level required to make informed decisions. So I sat on the sidelines. I watched other traders make fortunes buying beaten-down bank stocks that subsequently recovered. I watched opportunities that I'd identified go on to double and triple in value. And I felt completely comfortable with my decision to stay away. That's what discipline looks like in practice. It's not just about having the courage to buy when others are selling. It's also about having the wisdom to stay away when you don't understand what you're buying. It's about knowing the boundaries of your competence and respecting them. It's about being honest with yourself about what you do and don't know. Warren Buffett has a concept called the circle of competence. The idea is that you should only invest in businesses that you can understand and evaluate with confidence. For Buffett, that might include insurance companies, consumer brands, and utilities. But it doesn't include technology companies or biotechnology companies or cryptocurrency. Not because these aren't good investments, but because they're outside his area of expertise. My circle of competence includes technology companies, consumer discretionary companies, and some industrial companies. It doesn't include banks, biotech companies, or commodity companies. Not because I think these are bad sectors, but because I don't have the specialized knowledge required to evaluate them properly. This might seem limiting, but it's actually liberating. When you know what you don't know, you can focus all your energy on getting really good at what you do know. You can become an expert in a few areas instead of a dilettante in many areas. You can develop genuine expertise instead of superficial knowledge. And here's the thing about developing expertise. It compounds over time. The more you learn about technology companies, the better you get at identifying which ones have sustainable competitive advantages. The more you understand consumer behavior, the better you get at predicting which brands will succeed. The more you study business models, the better you get at evaluating management teams and growth prospects. This compounding of knowledge is one of the biggest advantages of a concentrated, disciplined approach to trading. When you're constantly jumping from sector to sector, from strategy to strategy, from system to system, you never develop deep expertise in anything. You're always starting over, always learning the basics, never getting to the advanced concepts that separate professional investors from amateur traders. But when you focus your efforts, when you specialize in a particular area or approach, you can develop insights that give you a real edge. You can spot opportunities that other traders miss. You can avoid pitfalls that trap less experienced investors. You can make decisions based on deep understanding instead of surface-level analysis. Let me give you a concrete example of how this plays out. By 2023, I'd been following software companies for over 3 years. I understood their business models, their competitive dynamics, their valuation metrics, their growth drivers. I knew which metrics to focus on, which management teams to trust, which market trends to pay attention to. So when a company called Datadog reported earnings in May 2023, and the stock dropped 15% despite beating expectations, I immediately understood what was happening. The market was concerned about decelerating growth rates and increased competition from larger technology companies. These were legitimate concerns, but they were also exactly the kind of temporary issues that create buying opportunities in high-quality businesses. I used one of my May trades to buy Datadog at $78 per share. Not because I thought the concerns were completely unfounded, but because I believed the market was overreacting to short-term headwinds in a company with excellent long-term prospects. My 3 years of following the software industry gave me the confidence to act contrarian when less experienced traders were panicking. 6 months later, Datadog had recovered to over $120 per share. The concerns that had driven the sell-off proved to be temporary, just as I'd expected. The company's fundamental strengths reasserted themselves, and the stock price followed. But I only had the conviction to make that trade because I'd spent years developing expertise in that particular sector. This is what I mean when I talk about the compounding nature of knowledge. Every trade you make, every company you research, every annual report you read, every earnings call you listen to, it all builds on itself. You start to recognize patterns. You develop intuition. You can make connections that less experienced traders can't see. But this only works if you're focused. If you're trying to learn about every sector, every strategy, every type of investment, all at once, you'll never develop the deep knowledge required to have a real edge. You'll always be a generalist in a world that rewards specialists. Now, I want to address something that I know some of you are thinking. This all sounds great, Marcus. But what about missing opportunities? What about all the money I could be making while I'm sitting on the sidelines waiting for the perfect trade? What about the opportunity cost of being so selective? These are fair questions, and they get to the heart of why most traders struggle with discipline. We're wired to focus on what we're missing instead of what we're gaining. We think about the trades we didn't make instead of the trades we did make. We worry about opportunity cost but ignore the cost of bad opportunities. Let me put this in perspective for you. In 2023, I made a total of 36 trades. That's 3 per month, exactly as planned. Of those 36 trades, 24 were profitable, 8 were roughly break-even, and 4 were losers. That's a win rate of about 67%, which is good, but not exceptional. But here's what makes this interesting. The 4 losing trades cost me a combined total of about 8% of my portfolio. The 24 winning trades made me a combined total of about 47%. That's a risk-reward ratio of almost 6 to 1. For every dollar I lost on bad trades, I made almost $6 on good trades. Compare that to what would have happened if I'd been making trades every day or every week. Let's say I'd made 200 trades instead of 36. Even if I'd maintained the same 67% win rate, the mathematics of frequent trading would have worked against me. More trades mean more transaction costs, more tax implications, more opportunities for emotions to override logic, more chances for small losses to add up to big problems. But more importantly, making 200 trades would have meant accepting a lot of mediocre opportunities along with the great ones. It would have meant buying stocks that I was only moderately confident about instead of waiting for stocks that I was extremely confident about. It would have meant spreading my capital across so many positions that even my best ideas couldn't move the needle significantly. This is the hidden cost of overtrading that most people don't think about. It's not just the money you lose on bad trades. It's the money you don't make because you've diluted your best ideas with average ideas. It's the opportunities you miss because your capital is tied up in mediocre positions. It's the stress and time and energy you waste managing too many moving parts. When you limit yourself to a small number of carefully selected trades, every position matters. Every decision gets your full attention. Every trade represents your absolute best thinking at that moment in time. You're not settling for good enough. You're waiting for great. And great opportunities do exist. They happen more often than you might think, but they require patience to identify and courage to act on. They're usually hiding in plain sight, disguised as boring companies with predictable business models. They're often available during periods of market stress, when other traders are too emotional to think clearly. Let me tell you about one of my best trades of 2023. because it perfectly illustrates what I mean about great opportunities hiding in plain sight. In September, there was a lot of negative sentiment around Costco. The stock had been underperforming the market. There were concerns about increased competition from Amazon and Walmart, and some analysts were questioning whether the membership model was sustainable in an increasingly digital retail environment. I'd been a Costco member for years, and I'd been watching the company as an investment for almost as long. I understood their business model better than most investors because I was actually a customer. I knew how loyal their members were, how efficiently they operated, how strong their supplier relationships were. I knew that the concerns about competition were overblown because Costco wasn't really competing on convenience or selection. They were competing on value and quality, and they were better at that than anyone else. So when the stock dropped to $490 per share, representing a price-to-earnings ratio of about 26 times, which was reasonable for a company with Costco's growth prospects and competitive position, I used one of my September trades to buy a significant position. The trade worked exactly as I'd expected, not because I'm particularly smart, or because I have access to information that other investors don't have, but because I'd taken the time to really understand the business. I knew what to look for. I knew what metrics mattered, and I knew when the market was offering me an attractive price for a high-quality company. 6 months later, Costco was trading at over $600 per share. The concerns that had driven the earlier sell-off had proven to be temporary. The company continued to grow membership, continued to increase sales per member, continued to expand internationally. The fundamental strengths of the business reasserted themselves, and the stock price followed. But here's what I want you to understand about this trade. It wasn't luck, it wasn't timing, it wasn't some secret insight that only I could see. It was the result of years of studying retail companies, understanding business models, and developing the patience to wait for attractive prices. Any investor who was willing to do the work could have identified the same opportunity. The problem is that most traders aren't willing to do the work. They want shortcuts, they want hot tips, they want someone else to tell them what to buy and when to buy it. They're looking for the easy button that doesn't exist. Successful investing is simple, but it's not easy. The concepts are straightforward. Buy good businesses at reasonable prices and hold them for long periods of time. But executing this strategy requires discipline that most people don't have, patience that most people can't maintain, and independent thinking that most people find uncomfortable. It requires you to ignore the noise, to think for yourself, to act contrarian when the situation calls for it. It requires you to be comfortable with uncertainty, to accept that you'll be wrong sometimes, to learn from your mistakes without letting them destroy your confidence. Most importantly, it requires you to change your relationship with trading itself. You have to stop thinking of it as entertainment and start thinking of it as business. You have to stop looking for excitement and start looking for profits. You have to stop trying to be right all the time and start trying to be profitable over time. This shift in mindset is probably the hardest part of becoming a successful trader. We're conditioned to want immediate gratification, instant results, constant action. But markets reward the opposite traits: patience, discipline, long-term thinking. The traders who can develop these traits, who can resist the urge to overtrade, who can wait for the really obvious opportunities, those are the traders who build lasting wealth. I want to share one final story with you, because I think it illustrates better than anything else why this approach works. Last month, I was having dinner with a friend who's been trading for about 2 years. He's smart, he's analytical, he works in finance, and he's been struggling to make consistent profits despite putting in enormous amounts of time and effort. He was telling me about his latest strategy, which involved using artificial intelligence to scan thousands of stocks every day, looking for technical patterns that historically led to short-term price movements. He'd developed this incredibly sophisticated system that could identify potential trades in real time and execute them automatically. It was impressive from a technological standpoint, but it wasn't making him money. I asked him a simple question. If you had to pick just one stock to own for the next 5 years, what would it be? He thought about it for a few minutes and said, Microsoft. Great choice. Excellent company, strong competitive position, growing markets, competent management, reasonable valuation. Then I asked him another question. How much of your portfolio is in Microsoft? He said, 0. He thought Microsoft was the best long-term investment he could make, but he didn't own any because he was too busy chasing short-term trading opportunities that he had much less confidence in. That conversation perfectly captures the paradox of modern trading. We know what works, but we don't do what works. We know that buying and holding great companies is the most reliable way to build wealth. But we can't resist the temptation to try to get rich quick. We know that patience and discipline beat speed and frequency. But we keep looking for shortcuts that don't exist. If you take nothing else away from this video, remember this. The stock market is a device for transferring money from the impatient to the patient. Every time you make an impulsive trade, every time you chase momentum, every time you sell a good stock because it's not moving fast enough, you're transferring wealth from yourself to investors who are willing to wait. But you can be on the other side of that transfer. You can be the patient investor who benefits from other people's impatience. You can be the disciplined trader who profits from other people's emotions. You can be the person who thinks long-term while everyone else is focused on short-term noise. It starts with making a decision. A decision to stop chasing every trade. A decision to focus on quality over quantity. A decision to prioritize profits over action. A decision to become the kind of trader who succeeds not because they're smarter than everyone else, but because they're more disciplined than everyone else. The market will always be there. There will always be opportunities. But your capital is finite, your time is finite, and your emotional energy is finite. Stop wasting these precious resources on trades that don't matter. Start focusing them on trades that could change your life. The choice is yours. You can keep doing what you've always done and keep getting the results you've always gotten. Or you can try something different. You can stop chasing every trade and start choosing the trades that actually matter. What's it going to be? If this video changed how you think about trading, if it made you reconsider your approach to the markets, if it gave you even one insight that could improve your results, then I need you to do something for me. I need you to hit that like button right now. I need you to subscribe to this channel and ring the notification bell so you never miss a video. And most importantly, I need you to leave a comment telling me about your biggest trading mistake and what you learned from it. Because that's how we all get better. That's how we turn expensive lessons into valuable wisdom. That's how we stop repeating the same mistakes and start making the same successes. The comment section is where the real learning happens, so don't just watch and leave. Share your story, learn from others, and let's build a community of traders who actually know what they're doing.